You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview.
Gotcha.
Hey guys, welcome back to another episode of Market Champions. Today we've got Jeff Snider. Jeff, you are officially the first guest to be on my podcast 3 times. So I don't know, congratulations.
Oh, thank you. I'm just waiting for you to send me my trophy or gift certificate or whatever. You got to send it to me in the mail. I'll look forward to it.
Absolutely. Awesome. So Jeff, tell us what the hell is going on, especially when you look at yields and when you look at the inflation numbers. So what are you thinking about these days?
Well, look, I mean, yeah, the CPI says one thing and then the bond market says something completely different. And over time, the two seem to be moving in opposite directions, right? Inflation seems to be going up, whereas bond yields have really taken on some seriously negative proportions here. And they're really at two diametrically opposing viewpoints, sort of. I think the issue is really one of timing. The bond market is looking ahead. The CPI obviously is about what happened last month or the month before, depending on the data.
Right.
So CPIs are looking behind, bond market's looking ahead. So not necessarily diametrically opposed viewpoints, just simply the CPI data is outdated. It's not going to last much longer. Looking ahead, especially when you look at real yields in the TIPS market, bonds market is saying, ugly, nasty, deflationary. Nothing has changed really much from last year, other than, what's driving the CPI isn't really monetary or economic factors. It's supply and demand factors that are idiosyncratic to, commodity prices or, the semiconductor chip market or something like that.
Got it. And recently, we had a lot of talk about SLR. So could you sort of explain, number one, what exactly SLR is and what exactly went on there?
You mean the SLR cliff, so to speak?
Yep, exactly.
Yep. It was one of those things where people were talking about it because they didn't really understand what it was, and then it just kind of disappeared because it wasn't really that big of a deal.
Exactly.
But essentially, there was these fears expressed in Bloomberg and CNBC and all these other places that essentially this SLR cliff was going to impose an undue burden on the banking system, and they'd have to puke treasuries, and that would contribute to rising yields. And it'd be all really awful stuff. And obviously it's forgotten because it never really happened. But essentially what happened was, in the wake of last year's crisis, so this was April of 2020, the Federal Reserve got together with the other 2 bank regulators and said, we're going to impose a moratorium on the SLR calculations related to bank reserves and U.S. Treasuries. Because with QE coming, you remember this is 2020, QE going to be huge. The federal government's going to be issuing treasuries. We want the banking system to at least temporarily absorb those things before doing a normal business and redistributing. So there was less of a regulatory cost imposed on U.S. Treasuries and bank reserves, but that was only for a 1-year period. So that ended at the end of March of 2021, which got everybody to panic over this because they thought, well, with the increased SLR costs on treasuries and bank reserves, banks aren't going to be able to afford it. They're going to have to sell treasuries. They're going to have to do something with the reserve, which, offset with deposit. All sorts of balance sheet of stuff was going to have to take place in order to fit in under this SLR cliff. And there was evidence that dealers were selling treasuries up until the middle of March, but then it turned out to be not a very big deal. And remember, it was the middle of March where long-term yields started to decline. So almost as soon as we started talking about this SLR cliff as some kind of big negative for the treasury market, no, things went the other way, which is why you haven't heard much of the SLR cliff talk lately, because where was it? It was nowhere. It wasn't really.
It wasn't anything at all.
It really wasn't. No, it was, push comes to shove in these kinds of environments, banks are going to hold liquid assets, regardless of regulatory constraints or not regulatory constraints.
Got it. Got it. And another thing that's circulating on Twitter right now is this RRP facility, and everyone in block letters is going $958 billion yesterday, and it's somewhere around there. So what exactly is going on with the reverse repo facility?
Well, what you hear, and this is this is not an either or thing. It's not exclusively one or the other. But by and large, the mainstream explanation is what the textbook all say, which is essentially that in an environment where bank reserves are plentiful, there are times when they could overwhelm money markets. And therefore, the Federal Reserve has this reverse repo program open to absorb excess reserves in case they start to disrupt money markets. And, it's pretty textbook stuff, right? If there's an excess of cash, it pushes down money market rates. The Fed has an interest in making sure that its major money market rate, federal funds rate, doesn't move outside of its target range, as it has occasionally. And therefore, this RRP helps the Fed, quote unquote, soak up excess reserves before they become a problem to the federal funds market, that is surely ongoing. That's part of the issue. QE has raised the level of bank reserves. The government has released some of those raised last year by draining its TGA balance, which is putting reserves into the commercial banking system. So there is definitely an abundance of reserves. However, that's not the end of the story. There's an other side of this, which there's always another side, especially when we're talking about repo, collateralized, and secured lending. Now, the term reverse repo kind of obscures the fact, but repo's in the title, right? So we're talking about some form of securitized lender, secured lending. Mm-hmm. And really what it is essentially, when you look at it from the perspective of a commercial banking system, the reverse repo is where you're a cash-rich counterparty, doesn't like your options in the private marketplace, so you can go to the Fed and lend it cash. Not that the Fed needs the cash. Remember what it's trying to do. It's trying to just take up excess reserves, but you're going to lend the Fed cash, and coming back is, Treasury securing this lending operation, treasuries that are sitting idle in the SOMA account. So in one sense, yes, soak up reserves, but in another sense, what the RRP could be telling us is that cash-rich counterparties, particularly money market funds that are heavily participating in repo and some other kinds of treasury bills, straight up treasury bills, they can't find a sufficient level of investments in either treasury bills or repo. Therefore, they have no choice but to go to the Fed's reverse repo. And if we think more along the lines of lack of collateralized opportunities for cash-rich counterparties, in one sense, in a very important sense, rising use in the reverse repo could be a signal of collateral scarcity in the rest of the environment. It's not a direct signal, it's mostly an indirect signal, especially since money market funds are the vast majority of the counterparties that are bidding or transacting in reverse repo. Also some money dealers, the GSEs are in there too. But by and large, it's, when you look at it from this other perspective, mm-hmm. reverse repo can tell you something about the collateral sufficiency in the rest of the system. And so the higher the reverse repo goes, the more you have to say, is it really excess cash, or are we starting to see more collateral scarcity? To get a sense of that, when we go back to when the Fed raised the reverse repo rate on June 17th from 0 to 5 basis points, that only increased use by about 230 billion the next day.
Right.
So it wasn't really an investment consideration. There's, because at that, I think on June 16th, reverse repo was still 500 and some odd billion. So before they even got off of zero, and then it went up to 700 some billion on June 17th when they paid 5 basis points. So there's more going on here than just cash looking for a return. In fact, I think it's more cash, finding that there's not a lot of collateralized alternatives in the marketplace. And so there's definitely a collateral scarcity signal in the reverse repo.
Got it. So what you're essentially saying is that typically what the Fed does is, so in a way, reverse repo is a reverse QE operation. So the commercial bank gets the treasuries and then gives the reserves to the Fed.
Yeah, I can see why you think that, but it's not. I mean, a QT is very different from reverse repo.
Right.
Reverse repo is more like a temporary open market operation where the
Right.
Fed does not want to change the systemic level of reserves. They're just giving the private marketplace a place to park them temporarily. Mm-hmm. Now, it's not meant to be a permanent thing, but at this stage, I mean, Jay Powell's not, this is going to go on for a while. We don't know how long, but it's going to go on for a while. So whereas QT, or quantitative tightening, is where the Fed says, we're going to shrink our balance sheet and shrink the systemic level of bank reserves, because the level of bank reserves is entirely controlled by the Federal Reserve, not the banking system. So, it's really not, it's not a systemic reduction in the level of reserves. That's not what the reverse repo is. It's just a temporary place for really money market funds to put reserves that they can't do in the private marketplace for the same type of characteristics.
Got it. And so one other thing that I wanted to ask you is, in your view, what is the single biggest risk to dollar, the US dollar being the global reserve currency?
Oh, the fact that it doesn't work. I mean, but here we are 14 years later, and it's still the only alternative. And I mean that it's the only alternative, and everybody knows it. Well, not everybody, but by and large, I think people certainly inside the system understand that this is the reserve system we have, and there's no real, I don't want to say threat, but there's no real alternative to it, because it's not so easy as just saying, hey, we want to use our currency as a reserve. You heard that a lot, especially going back to 2011, 2014, 16, whatever. Chinese yuan is going to replace the dollar. And, the Chinese were like, what are you talking about? We don't want to replace the dollar. We don't even have enough currency in our internal environment, let alone to spread currency all over the world. And really, that's what it comes down to. I think there's a lack of understanding of what a global reserve currency actually is and what it's supposed to do. Most people, you hear the term petrodollar, and it drives me nuts, because people think that petrodollar is a real thing. That's, the petrodollar. We have an agreement with the Saudis where we buy they buy our oil, or we buy their oil in dollars, and they reinvest them in treasuries. No, that's a subset of the entire Eurodollar system, and a very small and uninteresting one. A global reserve currency essentially needs to make itself available everywhere, or pretty much everywhere, because it's an intermediary. It allows Saudi Arabia to sell oil to the US using a single currency in between. It allows people, goods suppliers in Japan to be able to sell their stuff around the world, because nobody really wants yen. But if you intermediate through the dollar, because dollars are plentiful in Japan and as well as outside of Japan, that's a global reserve currency that actually works. And that's really something the Eurodollar did very well from when it started in the 50s. And really, there's some remnants that maybe go back into the 40s, but somewhere in the 50s, the Eurodollar really took over the reserve currency role. And it did it really well up until around the 80s and 90s and middle 2000s, when it just went, forgive me, freaking insane. It got way out of hand, and that was really the problem. So not only did we have currency that was available everywhere, we had too much currency. Yep. That's why we had asset bubbles, housing bubbles in the US, we got corporate debt bubbles all over the world. So there was too much currency. But since then, we've got a problem where there's not enough Eurodollar currency, which is, let's be clear here, we're not talking about Federal Reserve notes. We're not talking about pieces of paper with the Fed's printing on them. We're talking about essentially bank liabilities. This is a distributed ledger, virtual currency, reserveless currency system, which is, if banks don't want to participate in it because they judge it to be too risky, there won't be enough currency. It's really a banking problem. And that's really why, the global reserve currency has kind of broken down for the last 14 years, but there's also no alternative to it, because you can't just start from scratch and say, we're going to, like I said, you can't just plug something in. You have to have infrastructure. You have to have the ability. You have to have widespread acceptance and confidence that, you can be able to do all of these functions of a reserve currency, which are, again, misunderstood, misidentified, and largely people don't even think much about them.
Got it. And is there actually any? So one thing that you just focused on was the concept of bank reserves, and bank reserves not being cash. So can, say, JP Morgan go to the Fed and say, and exchange, say, 1 billion in reserves for, say, 1 billion in cash, and go around and say, pay JB Diamond and $100 million or so. Is that something that the JP Morgan can actually do?
It is, yes, that's a legal option. In fact, that's really the whole point of bank reserves to begin with. Going back to the early days of the Fed, bank reserves are nothing more than a clearinghouse debt certificate, something like that. It's an internal interbank kind of ledger balance that says, first of all, it's useful for calculating required reserves. Not that it's satisfies any kind of actual liquidity needs. If depositors are coming into a bank and withdrawing physical cash from your vault, the Fed's bank reserve doesn't help you, but it does help in case of, state regulators or federal bank regulators, because you can say, yes, I have X number of dollars in my vault, but I also have X number of dollars in Federal Reserve bank reserves. And so the bank regulators are not going to shut you down because you have sufficient, what they consider sufficient liquidity. But in the case of a deposit or withdrawal, you can convert bank reserves into physical cash. In fact, that's really kind of the point. The Fed is saying, I'll print you some cash and send it off to you so you can satisfy the liquidity needs of your customer deposit base, so they don't strip your vault down to zero. But, nowadays, that kind of a thing is non-existent. Even the 2008 crisis, there were very rare instances, things like, places like Northern Rock, where customers rushed. IndyMac is another. I mean, that was a small bank where customers rushed to convert their deposit liabilities into physical cash. By and large, you had an interbank problem. Yep. And that's really supposedly what bank reserves are best at, is settling deficiencies in Fedwire or chips or whatever it might be, when in fact that's really their only use. Now, in the example, the hypothetical you just raised, yeah, any bank can say, I want $1 trillion, or, I've got $100 billion in reserves with you, Mr. Fed. I want to convert that into actual physical cash. But no bank would ever do that. There's a reason why there isn't much cash in the banking system, because it's a big pain in the butt. It's not just a pain in the butt. You've got to account for it. You've got to have guards for it. You got a place to store it. There are real costs involved with managing a paper physical cash system. The banks have clearly said, we don't want to get involved with it. Otherwise, they would be doing that, right? So it doesn't, in Europe is a perfect example where the cost of this virtual reserve system with negative interest rates being imposed by the ECB are up to 50 basis points. That's the deposit rate floor, which says even at minus 50 basis points, banks are willing to hold these electronic reserves, even though they're being penalized, rather than convert them into physical cash, because the opportunity cost of physical cash, the real physical costs that go with holding cash, must be some level greater. So there's really no reason for the banks to say, I want physical cash, because for the last really 70 years and even longer, you go back to some of the 1940s and 30s, you read, the Federal Reserve will tell you, hand-to-hand cash is used for such a small part of economic transactions. It's not really an important thing. It only becomes important during these physical, convertibility crises. Right. And we're not going to have anything like that, in the modern system, because you don't want to hold cash. I don't want to hold cash. I want to be able to pay things with, the chip in my credit card or my phone even, so that's really not an issue. And it's not something the banking system is really thinking about, because why would they?
Right. So another.
I think where you were going, that narrows the use of bank reserves even further, right? Because they're essentially an interbank token that has a very limited usage. And I would also add that it doesn't have just limited usage, it also has limited distribution, because of the way quantitative easing works and the way the rest of the marketplace has gone with risk aversion. These bank reserves tend to pool up only with the largest banks. It's not like they're widely distributed. So even though they're an interbank token already, they're really kind of not hoarded, but they pool up at the largest firms because they're the ones that are most engaged in quantitative easing.
Got it. And so one more thing related to these bank reserves is so let's say the Fed decides to conduct some open market operations in treasuries. So they're going to the open market and they're going to go buy treasuries. And so let's say the person on the other side is some sort of hedge fund that has a treasury portfolio.
Nope. Stop you right there. You've gone off the rails already. Quantitative easing can only be done between the Fed and primary dealers. So there is no Fed buying securities from hedge funds. That doesn't happen.
Okay.
So then that's really the purpose of being a primary dealer. Number one is it gives you the privilege as well as the burden of participating in U.S. Treasury Department auctions, but it also gives you a special rights to deal with the Fed and quantitative easing and things like that.
Okay, got it. And so
no, that's kind of what it goes to what I was just saying, which is why reserves tend to pool up with the primary dealers, especially the bigger one, because they're the only ones that are transacting with the Fed.
Got it. And so since these reserves are technically cash, even though banks don't want them to be cash. So if the Federal Reserve was by law, allowed, or Congress passed a bill that amended the FRA to allow the Federal Reserve to directly monetize central bank debt. Would that actually lead to inflation? And uh, would all that money still end up in reserve some way or the other? Because say Congress, if they monetize, say, the defense budget, Congress is going to go buy a jet from, say, Lockheed Martin, and then Lockheed Martin is going to go put that into their bank account, and then the bank is going to take whatever deposit that Lockheed Martin put in, and then go put that at the Fed as reserve. So let's say by law the FRA was amended to allow the Fed to directly monetize that. Would that finally cause inflation?
No, I don't think so, because you're still talking. You haven't really talked much about what the condition in the real economy is. As I said before, I mean, Japanese experience and even our recent experience here in the U.S., where it wasn't the Fed doing it, but the Treasury Department actually did a helicopter. It did 3 of them, and there's still more ongoing. I mean, people with children in the U.S. are getting paid right now as we speak for their children. So there are helicopter drops being, the Treasury Department is putting dollars directly into the real economy. And you could say, yes, that's having an inflationary impact, because it certainly has pushed up these CPIs recently.
Right.
But we don't know that's going to last. In fact, the evidence is continuing to mount that it's not. Now, I know people are going to say, oh, you're crazy. The CPIs, they're going to continue to go forever. But yet the best gauge we have on future inflation conditions says that not only is that a small chance, those small chances are getting smaller and smaller and smaller by the day. The bond market deflationary yields are saying this CPI stuff isn't going to last. There's too much that's wrong in the economy, that flood of digital cash directly pushed into not just consumers' hands, but also businesses. We had the payroll, whatever it is, PPP or whatever. I mean, any number of acronyms that they came up with initially in the CARES. So there's been all sorts of ways the government has been trying to inject all of this cash into the real economy, and the bond market is completely unimpressed.
Mm-hmm.
It's basically saying, yeah, it had a temporary impact, but that's all it's going to be, because we haven't talked about the real state of the real economy, the real state of the monetary system, which is probably shocking to most people, really bad shape, both of them.
Yep.
Despite quantitative easing, for example, one of its primary intended channels is to get banks to lend. It's called a portfolio effect channel, which is essentially, I'm taking these treasuries out of your hands. You got to go do something, because I've taken an earning asset out of your hand. And if you want to stay in business, you got to earn some money. You better go out there and lend to people. That's really what QE is supposed to accomplish. That's where inflation comes from. It comes from lending, because lending is banks spreading credit and money throughout the real economy in a very wide and broad fashion. That's how you get recovery. That's how you get inflation. That's where it actually comes from. But banks continuously, and they've done this for 20 years, they refuse to lend.
Yep.
What they do is they transact with the Fed. The Fed takes a safe asset out of their hands. They go into the market and buy another one. And that's all that happens, because banks are risk averse. You've done nothing to address that primary impediment, which is also the monetary impediment, which is this risk aversion. And it's liquidity risk aversion is more so than credit risk aversion. So yeah, the federal government can come in and plow all sorts of trillions into the real economy directly into people's hands, and that'll have a temporary impact. And then we'll go right back to where we were before, because nothing has really changed.
So what exactly did say? A lot of the, I guess, hyperinflationists tend to put forth the arguments of Venezuela and Zimbabwe. So what exactly did they do in order to end up with hyperinflation?
Well, they actually printed money.
So wouldn't monetizing debt directly be the same as printing money, or
not necessarily, because you're not printing actual money. I mean, I don't know why this is such a hard concept for people, because I forget, some famous hedge fund, David Einhorn, I think it was, said, this inflation can't be transitory because too much money chasing too few goods. And, again, there's he's wrong in a couple different parts. And number one is bank reserves are not money. They're a narrow use interbank token that isn't widely distributed. That's number one. And number two, we also have this entire global dollar system that exists outside the US, independent of the Federal Reserve. So while you're paying attention to the US CPI, you're not paying attention to the rest of the global system, which is telling you that US CPI is an outlier. It's a huge outlier. if you map, for example, the USPC deflator against the European inflation, HICP, what you'll find is they are in lockstep for years and years and years up until the last couple months. So either the US is leading the charge in this inflationary money or global money, the US CPI is going to come back down where everybody else is. And it's not just Europe, it's Japan, China, everything else in the rest of the global economy that says global money is not too much money chasing too few goods. It's really a bad situation where we have still too little economic growth opportunity and not enough money in the rest of the global system. So if you're looking at only bank reserves or M2 or one of the anachronistic, traditional definitions, you're not looking at the right thing, which is you have to look at the entire global monetary system. And the only way to do that is by looking at markets. What is this global monetary system? As I told you before, as I said before, and you know this, it's the banks. The banks operating that system. How do they tell us what they're doing in the monetary system? Well, look at bond yields, look at Eurodollar futures curves, look at all these other things that tell you what the banks are doing. If the banks, if bond yields are falling, that's a really good indication. And I mean that. It has a really good solid track record of saying, listen to bond yields, not the screaming hedge fund guys and bond kings on, CNBC and Bloomberg, because they have no frigging clue how to read these things, because they're still trapped in this mindset that the U.S. system is a U.S. system. It's a closed system, and the Federal Reserve is a central bank, and it matters to that system. When none of those things have been true for decades, I'm talking 6-7 decades. The Federal Reserve is simply not really a central bank, and it's certainly not a dollar system central bank. There's this wider global reserve dollar system that's going to be where you see whether or not there's too much money or too little money. It's not a US thing, it's a global thing.
Got it. And the Federal Reserve has now started to innovate and bring about the CBDCs and the Fed coin, and Lagarde's talking about the digital euro. And so what do you think that would look like? And what implications would that have for, say, inflation versus deflation?
Zero.
And would it solve anything related to the global collateral shortage in the Eurodollar system?
CBDCs are a joke. They're a complete utter joke. What they are is, first of all, for a long time, going back to 2009, Bitcoin showed up and everybody just laughed. I mean, digital currency, what the hell's that? We don't even know what it is. Then they started to strangle it in the crib by saying, okay, the IRS ruling, you got to treat crypto as like an investment. Therefore, it's not money. You got to report 1099s. You got to do all this. I mean, they really tried to hammer it in. Okay, so that was 5, 6, 7 years ago now. They've been trying to put limits on it to try to strangle this before it became big. And so the CBDCs are essentially them saying, oh crap, we couldn't stop it. In fact, if anything, crypto and digital currencies have proliferated. They've been very successful, not in terms of their price bubbles, which are ridiculous, and we can talk about that if you want. But the technology, I mean, they've evolved and innovated, and there's all sorts of really good stuff involved because there's a place for crypto that's caused by a dollar shortage and the lack of money. However, CBDCs are simply these central banks trying to play catch up, and they're not really trying to invent a new crypto. They're not trying to keep up with the arms race for Tether versus Bitcoin or Ethereum versus anybody else. All these stable coins. They're just central banks trying to put essentially a 21st century gloss on paper physical Federal Reserve notes. It's really no different than what the Fed has done before, or the ECB or anybody else. And I don't expect anybody to take these seriously. In fact, nobody really has outside of the financial media, because like the lapdogs they all say, oh, everything the Fed does is awesome. So we're going to pump up, this Fed digital currency initiative in partnership with MIT's digital tech. I mean, it's all academics and economists talking to academics and economists who have no idea about money and how it's really used. Right. Meanwhile, in the private sector, they're already half a decade or more behind. They're trying to play catch up when that gap isn't shrinking. It's only growing by the day. So by the time the Fed or the ECB gets ready to launch one of these, I mean, it'll take them 3-4 years, because they'll have to study the problem. They'll have to have committee meetings and congressional testimony, all sorts of bureaucratic red tape. And by then it'll be such a pitiful thing that it won't make any difference. I know people, oh, but China's got this digital yuan.
That was my next question.
Yeah, China's digital yuan, that changes everything. Well, no, I mean, Chinese digital yuan is not meant to be a competing currency. It's meant to be a surveillance device.
Right.
That's all it really is. And I think that's probably what the Fed is thinking too, is we don't really know how to build a digital currency, but we'd really love more information about how money circulates. So
Yeah.
we'll build a surveillance device too. So, it's you think about what are the properties of money and what is it that China's digital yuan solves in terms of those properties of money. It doesn't, I mean, it's not one or the other. It's not like the Chinese yuan represents some new form of elasticity. On the contrary, I think it's actually opposite because, thinking about the surveillance capabilities of it, I think it would be a disincentive toward further use, especially, I'm not talking about criminals, but just regular folks who do go about their business and don't really care for that kind of intrusiveness. I mean, obviously in China, you don't have a whole lot of choice in the matter, but in wider terms, it's not really a currency in that respect. It's more about, like I said, it's building out digital surveillance.
And do you have any thoughts on a possible devaluation of the regular yuan? I forget the digital one. So do you have any thoughts on it? And, in your view, what are the odds of, somewhere in the near term, say, 6 to 12 months, China devaluing the yuan?
They don't have, I say that, I mean, Chinese authority have no control over the currency. And I know that's people are like, what are you talking about? They devalue all the time. No, the dollar devalues the currency, not the Chinese authorities. And this has been proven time and time and time. I mean, all you got to do is chart, for example, the US dollar exchange rate versus yuan against their internal RRR. You can see that it's dollar flows that determine the direction of yuan.
Right.
Now, that said, that doesn't mean over the short run periods, Chinese authorities don't attempt to intervene, but they don't intervene to weaken yuan. They intervene to try to keep it from weakening. They try to keep it from falling, because falling yuan is, as I write, the most simple equation you'll see. CNY down equals bad. It doesn't equal bad for just China. It's bad for everybody. Not because CNY is falling, because CNY falling represents dollar system becoming more of a problem. And that's really the bad thing. So if you see CNY falling, that's not the PBOC weak, trying some export stimulus or, beggar thy neighbor currency war. On the contrary, what it is the dollar system becoming deflationary, global dollar shortage, pushing not just yuan down, but many other currencies down too. Whenever you see the dollar rise in exchange value, that's not, the US authorities bringing it up. That's not Chinese authorities trying to bring their own currency down. That's dysfunction in the dollar system becoming a real problem. So in short run interventions, even PBOC, as well as other, SAFE and other places, they have an interest in keeping the yuan from falling, not devaluing it, but they don't want it to fall. And over the last, 6 months, what we've seen is that the prior fall in the yuan has sort of kind of reversed a little bit here, and it's starting to look a lot like 2018, where you had it roll over from this, temporary period of a rising, quote unquote, strong yuan, which was indicative of dollar reflation, into quite quickly in 2018 into this deflationary dollar shortage position. So we'll see if that continues in 2021, where we already see, today's a perfect example. We got trading today where the yuan spiked above 650 or below 650 to the dollar, which may be one of those things that you start to say, all right, we're starting to see more and more shortage. So in that kind of a situation, going along with collateral problems and everything else in the global reserve currency, the UR dollar, it wouldn't be surprising to see yuan fall, not because Chinese authorities want it to, because they have no choice. They're along for the ride like everybody else. Once the euro dollar gets going, dollar shortage gets going, it's practically, that's it. Once it passed that, some unknowable threshold point of no return, it's going to do what it's going to do.
Got it. And making our way back to talking about inflation. So one thing that I wanted to ask you is, so you typically argue that, for example, Japan, the Japanese government has spent trillions and trillions of yen in fiscal policy, and still we haven't seen any inflation there. So Well, so would the problem actually be that we aren't spending we aren't spending quite as much as required, and economists tend to people who actually propose that argument tend to bring up potential GDP charts and then show that there's actually quite a large quite a wide differential between what potential GDP is, however they define it, versus what actual GDP is, and that gap should have been closed by incremental fiscal policy. And
But it never was. It never was. That's the point. And, that gap, that output gap, is deflationary. What it's saying is there's so much slack in the economy, and the fact that the Japanese government, despite spending trillions, was never able to close it tells you those two things. Number one, it's ineffective. And number two, it ends up being deflationary because it actually widens the output gap because you're using the most wasteful, inefficient form of quote unquote aggregate demand. And what economists say, especially neo-Keynesians, is that it doesn't matter. Any spending is the same as every spending, right? If the government spends it or if the private sector spends it, and it's proven time and again. No, the private economy needs to create sustainable enterprise, which is what we call wealth. Otherwise, you won't be able to close that output gap. Doesn't matter how much temporary spending you throw in through government channels, it doesn't change that problem. It just temporarily, you can temporarily increase output, but that doesn't lead to the sustainable recovery, which would close the output gap. And in fact, in the United States, we've already been through this, which is over the last decade plus, since 2008, the quote unquote Great Recession. What has happened is exactly that. Despite fiscal spending and President Obama's ARA, despite 4 QEs and then the fifth in 2019, they said that the economy recovered not because it ever closed the output gap to where we thought the output gap was before 2008. They wrote down economic potential so that it matched output, which is essentially admitting, well, we couldn't get the economy to grow again, so it must be the economy's broken, rather than thinking and correctly concluding, no, your stuff never worked. The economy's not broken. It's just you guys don't know what the hell you're doing.
But then go on.
This isn't a problem that economists always raise this magic number issue. Whether it's QE or fiscal spending, what ends up happening is failure. And then economists go back and say, oh, it wasn't big enough. It must not have been big enough because we know fiscal spending and QE works. Well, how do they know? They have a bunch of simplified equations. They don't have any real world evidence that it works. What they do is they have a bunch of correlations that suggest maybe it does work, even though over the last 30 years in Japan and the last 15 years in the rest of the world, it doesn't work. It's shown time and time again, none of this stuff works. And so presented with failure, their argument is always, well, it wasn't big enough. Well, if you guys knew what the hell you were talking about, you would say it wasn't big enough meant, right? You would say, out in 2009, for example, outside of Paul Krugman, practically every economist was happy with the scale of the ARA. They thought this is huge. This is like the New Deal all over again. So if they knew what the hell they were talking about, what they were doing, they would have said it beforehand, oh, this is not big enough. You don't wait till after it fails to say, well, maybe it wasn't big enough. And that's the same thing with QE, because that's exactly the argument every central banks make. They do a QE, which is supposed to be quantitative easing, which is we know how much easing to do to get where we need to go. If you got to do it again, obviously you didn't know the right number for the first time. And so that already says something's missing here. We're not, your theory might be a little bit off. And it really comes down to it doesn't work. Okay, if you have to repeat QE, if you repeat government spending, obviously it's not that it's not big enough, it's that you're doing the wrong stuff. You're looking in the wrong direction, and you're probably making the situation worse, which we know for a fact with QE, because QE strips collateral out of the system, which is itself deflationary.
Right.
So it really comes down to the fact that economists have no other ideas because they don't look in these kinds of monetary details and think, well, maybe this bank reserve stuff isn't money printing. Maybe monetary policy doesn't help. Maybe aggregate demand can't just be filled by any kind of spending anywhere, anyhow.
Right. But wouldn't the example of the New Deal right after the depression, because a lot of people tend to credit the New Deal and FDR with, bringing back the economy from the depths of the depression. Would you not agree with that?
FDR doesn't agree with that. Look, the economists of the 1930s understood pretty well, more so than the politicians who've made, this is a political story you're telling, not an economic story. If you read, I mean, just go to FDR's campaign speeches in 1936, for example. What he said was, well, you got to give us partial credit because we've come partway back. We haven't recovered, but we've come partway back. And that was still the message in 1940. It just got buried under World War II that was going on in Europe. But by 1940, I mean, Republican position was always, this hocus pocus stuff that you kept, you imposed these experiments on the US economy, they haven't led to full recovery. And you look at the economic statistics by 1939, that was true. The economy did never recover. In fact, it suffered that major setback in 37 and 38 because it was still in such a precarious shape that it hadn't recovered. So anybody that's making the argument that the New Deal created a recovery, no, the New Deal kind of did what fiscal spending has done in the 21st century, which is it creates some kind of temporary spending.
Relief. Yep.
But other than that, you can make an argument that was enough by itself. Getting paychecks to people that had been, millions upon millions who had been unemployed, that's not necessarily a bad thing. But let's not call it stimulus that's going to lead to recovery. Let's call it what it is, which is aid to harmed workers or aid to harmed businesses or things like that. There's an argument to be made for that, but it's not an economic argument.
It's a political
one. More of a moral argument.
And, but then post 1939, World War II, lots of government spending, focused on building, focused on industrial production, so on and so forth. And that sort of recovered.
No inflation. I know. Yes, there was price controls, but, why was there no inflation despite the dramatic increase in government spending, as well as banking? The banking system ballooned to finance World War II. And we've already given you the answer right there. I mean, World War II isn't like we're building new economic, potential. We're destroying economic potential all over the world, especially Europe and the Far East.
Yep.
So,
and
again, it matters what goes on in the economic environment, not what governments are doing in response to it. And in many ways, what history has shown, especially in these big depression eras, is that governments are essentially powerless. They cannot solve the depression equations, despite the fact that they continue to convince themselves, the financial media, and the vast majority of the public that they can. And it doesn't matter how many repeated examples we have of their failure. Most people just don't pay close enough attention to know that they've failed. They think that, the economy was booming before COVID, right? I mean, all we heard about was the unemployment rate, when in fact, as we just said, no, there was a massive amount of macro slack that was left over from 2008. In fact, and it wasn't just the US, it's the global system that has built up this macro slack that has never been solved. And economists are stumped because they continue to look in all the wrong places.
And so, since you've sort of shown us that, fiscal spending and government policy, it does not actually cause inflation. And, people keep saying more, but then when you do more, nothing really happens at the end of the day.
Well, let me clarify. Government spending could cause inflation, but it won't cause inflation under these conditions. In these deflationary environment, it's just not going to happen. And it's not going to change the deflationary environment either. It's what we're boiling it down to, as we just said, it's essentially boiling down to an argument of whether or not, there's a moral argument that the government should step in and help people who are hurting. But let's not fool ourselves into thinking that's going to fix the economic situation, because it's not. So there's a moral argument for what the government has done in the US over the last year, paying people and paying businesses and keeping them afloat. But expecting that to lead to some sort of inflationary recovery, that's entirely misplaced. And I think that's part of the problem here too, is that, it's always called stimulus, which you expect something to be stimulated when in fact it's really not. What it really is intending to do is offset a huge negative that, that's really all what matters.
Got it. Okay, so let's make a shift away from fiscal spending. And so one thing I wanted to ask you about is, countries like Australia, Canada, and New Zealand, we've got very high housing prices. So is there actually a link between these housing prices in these countries and the shadow banking or the shadow banks or the Eurodollar system?
No, in fact, if you look at the US, is also its housing market is completely on fire too.
Yep.
There really isn't. because those prices are being focused through a narrow bottleneck where, there isn't a whole lot of supply, right? There's a frenzy of demand and there's not a whole lot of supply to meet it. In fact, even you look at new homes, for example, new home sales skyrocketed in the wake of 2020, March 2020, but yet they never even got close to where the peak was in 2006. So, the housing market, yeah, it's still repressed from, the last housing bubble, which is essentially, this isn't a bubble. It's essentially a mismatch between demand and supply. We had an uptick in demand and not a whole lot of supply to meet it. So that's an imbalance of prices. And a lot of it is sentimental, not monetary, right? Because people are out there believing that, there's inflation, we need to buy houses, or, there's a lot of other reasons for demand in housing too that doesn't link back to the Federal Reserve or the Bank of New Zealand or the Reserve Bank of Australia, or whomever you want it to be that's supposedly driving it. It's not low rates that are doing it, though low rates do contribute to demand. It's really essentially the fact that, the environment is conducive to all these temporary imbalances. In fact, you look at new home sales in the US, they've collapsed over the last 3 months, which is suggesting that, some of that imbalance leading to massive price increase is already causing the regular small e economic response, which is once prices get too high, demand's going to fall off and it's going to naturally correct itself. That's not inflation. That's not a credit bubble. It's not monetary policy.
Right. And there are people who also blame, the Federal Reserve buying these mortgage-backed securities for higher housing prices. So how far do you agree with that? And, and if the Federal Reserve, tomorrow said, and, tomorrow they literally have a meeting, but if they came out and announced tomorrow that, they were going to stop, cold turkey on these MBS purchases, what would be the impact, especially on yields and the overall housing market?
Well, I don't think most people understand how QE works on the MBS side anyway, which is not surprising because it's, it's opaque and there's complexities. I mean, I don't think people who are making that argument even are aware of the TBA market or dollar rolls or how the Fed actually works in these markets. The Fed isn't actually encouraging banks to buy, how encouraging people. They're not funding mortgages, for example. They're influencing, production coupons in the MBS market, which is an entirely different thing. It's essentially saying we're going to subsidize banks who want to create MBS securities through GSEs, which is an entirely different set of friction. So it's not like the Federal Reserve's monetary policy, quote unquote, buying MBS is creating this kind of advantage to home buying, because that's not really what's going on. As I said, I think what's going on is the lack of supply was not responsive enough to this massive increase in demand. And it's not like the Fed just handed out money. That was the government that did that. The federal government that handed out money. But that's, you're not going to buy a house because the Treasury Department gave you $1,400.
Mm-hmm.
I mean, maybe that helps you with a down payment, but you still have to pay the mortgage and you have to qualify for the mortgage and everything else.
So how exactly I'm curious. So how exactly does MBS QE work? And could you sort of describe that mechanic there? We could do an entire podcast on it, I'm guessing.
Yeah, I don't think you want to do that here. But essentially, what happens is the Federal Reserve buys in what's called the TBA market, which is to be announced. And really, you have to understand how mortgage-backed securities are put together. It's not like banks have, you want to put together $1 billion MBS, securitized mortgage pool. Well, you don't just have $1 billion in mortgage loans laying around. You've got to go through the application process. You got to go through the verification process. So you have essentially 3, maybe 4 months, 4-month lag between when a mortgage starts and when a mortgage closes. But in a lot of ways, you want to pre-fund a lot of that stuff. And so you have all of these mortgages that are accumulating on a bank's balance sheet that go into what's called the TBA market, which is essentially like a repo market with illiquid loans. And the Fed comes in and sometimes buys up in TBA coupons. Sometimes it does things in dollar rolls, but it isn't like they're buying just, like treasuries, for example. They're not buying securities that are already packaged together. They're essentially trying to make it easier and more, subsidized and profitable for banks to complete the process, because putting together mortgage securities is a messy, complicated task. It isn't just, It isn't like we just have a pipeline of mortgages and we know exactly how it's going to turn out. So it's more of a softer influence on bank behavior, trying to make it seem like it's more easy because you can pawn off some of the TBA that didn't get funded into the pipeline. You can pawn that off on the Fed. There's also repo and collateral considerations. There's dollar rolls to take into account. I mean, there's a whole bunch of stuff that essentially adds up to more of a soft influence on mortgage than simply just buying securities.
And what is
the short version?
So wait, what is a dollar roll?
Let's not get into that.
All right.
We're kind of going off in a different direction here than I think you probably want to.
Yep.
Look,
Okay.
if somebody wants to know about dollar rolls, just Google. I mean, you won't get a good explanation, but I mean, there are papers out there that can tell you how this stuff actually works.
Got it. So one thing that we've seen over the past couple of months is, I guess, higher than 2% inflation, and a lot of that is blamed on base effects and temporary supply bottlenecks. And people have pointed to lumber. Lumber just flew up and then flew down once the supply imbalances were corrected. So after I guess around which month will these numbers start becoming signals and have less so basically around when will the signal to noise ratio start to become high again?
I think we've already seen some of the rolling over, like in the PPI, for example. You've seen the commodity index has kind of plateaued over the last couple of months, and some of the components of the PPI have actually started to soften. So maybe that we're starting to see some of the price pressures come down. Yeah, I mean, there was some base effects in some of the numbers, but it wasn't that. I mean, prices really are moving quickly. They certainly moved more quickly than I was expecting. I think they're moving more quickly than a lot of people were expecting. But as far as coming up with some kind of prophecy about when they're going to stop, I mean, who knows? I mean, it's impossible to predict, I think. And it's really why, you look at market signals and say, well, I don't know when the CPI is going to come down, but as bond yields, not just in the US, but globally go lower and lower, the probability that they are going to come down at some point just goes up and up and up. And so at that time, when you look at it that way, it doesn't really matter when, because we're getting more and more certainty about the fact that it will happen. So you want me to give you a date? it'll be September 23rd at 4:30 in the morning. That's when the CPIs are going to change. No, we don't have that kind of level of precision. And it's true. I mean, even when we look at, for example, in the tips market, we look at inflation break-evens. It sounds like the market is saying we expect the average CPI over the 5 years, the 5-year break-even, to be about 2.56%. No, you don't take these things literally. They're not precise measurements of market expectations. We instead look at relative changes and relative condition. And still, even now, for the last almost 7 months now, inflation break-evens have been inverted, which is that short-run inflation expectations are much higher, significantly higher than longer-term inflation expectations, which is another way of the market saying, we don't know when, but we're pretty sure it's going to happen.
Got it. Is there actually a mechanical link between the Fed's expansion of its balance sheet and stocks? So no. Because the typical link that you explained is that it typically influences narrative to an extent, and also expectations policy, which is how the Fed actually operates. But there is no mechanical link at all between stocks and
and I always, people who say that, I challenge them to show me it. Draw the line between the Fed's balance sheet and the New York Stock Exchange. You show me how that works. And nobody can, because there's no way. I mean, you don't see equities piling up on the balance sheets of banks. In fact, banks don't own equities at all. So how do we get from bank reserves, which are only held by banks, to equities? You don't. There's no line there. It's completely sentimental. And the best example of this is 2017, when the stock market went nuts, went through the roof, while the Fed was actually leveling off and then shrinking its balance sheet. And the reason the stock market went nuts is because it bought this narrative of globally synchronized growth, which was perpetuated by the Fed shrinking its balance sheet, which is essentially a signal to the market, hey, we're so confident about this globally synchronized growth stuff, we're going to shrink our balance sheet. That's how confident we are. And the stock market went, yes, the Fed's so confident, buy, buy, buy. Of course, it was the exact wrong thing to do in terms of what the Fed was doing, because instead 2018 wasn't inflationary. 2018 was a mess. And then 2019 was a complete disaster. So the stock market in particular is divorced in almost entirely from fundamentals through these sentimental psychological effects of, people in this business, financial services, the business I'm in, essentially looking for some way to justify what they want to do anyway, which we all get paid more when stocks go up in price. So we want to buy stocks, and we're really, really, really itching to pull the trigger. And if Jay Powell gives us some cover, whether it's QE going up or QT going out, does not matter. We just want the Fed to tell us it's okay to buy as much stocks as we want to buy. And that's what happens.
Mm-hmm. Yep. And one thing that we see today is, we see these long-term structural deflationary pressures as it relates to demographics in Europe, Japan, China, to an extent the U.S. as well. But you rarely see this mentioned anywhere, because a lot of people are just debating inflation, deflation, this, that, or the other. So what is your view on structural deflation, and what would the game between different currencies look like in sort of a global secular deflationary trend?
Well, we have a secular deflationary trend. It just does nothing to do with demographics. If there was this secular deflationary trend was paramount, then you would expect economic growth to line up with the change in demographics. It doesn't. Mm-hmm. Where does economic growth break down? In 2008. 2008 was not a demographic, it wasn't the opposite of the baby boom. It wasn't like we had a bunch of old people show up and retire all at once. I mean, that's kind of the argument you have to make if you want to make a demographic example of the secular deflation. You have to say, well, a lot of people retired in October 2008. That wasn't what happened at all. We had a global crisis, a global dollar shortage. So to me, the secular deflation that matters most is in the monetary system, not demographics. And I tend to believe that demographics follow economics, small economics, which means that if we ever get to a point like the 1940s and 50s, where we fix all of these past problems, I thoroughly believe that we'll see another baby boom. Mm-hmm. It will be inflationary in the sense that I think people have been putting off a lot of things. I forget who I just had this conversation with just recently. But you look at, people your age, for example. You guys have been, your cohort, millennials, Gen Z, you guys have been screwed over by the fact that the economy has been broken for so long. I mean, I don't know how old you're what, 18, 17. 19 years old. Yeah. 17. So, I mean, you probably don't know what an actual economic boom looks like because you've never seen one. You were a baby when the last time we had real economic growth. And even really before that, you got to go back to the 1990s in the United States. So the fact that, it's not necessarily, the idea that millennials hate cars, for example, this is what we were talking about. I don't think they do. They can't afford them. The joke was that they had to live in their parents' basement because, I guess because their parents made them so comfortable. So, I mean, no, they couldn't afford to leave the house. And the further extension of that is they can't afford to have families because they have all of this economic pressure upon them that maybe they aren't even aware of, where it's an actual impediment to demographics, essentially. So I thoroughly believe the secular demographics is the monetary system, and that once that gets fixed and we get into a legitimate growth environment, which we haven't seen in a long time, I think some of these demographic issues will change entirely too. Not just for those reasons, but for also, this stuff tends to be cyclical too.
Got it. And so in our first interview that we ever, so this is our third interview. So in our first interview, you said that the solution would lie somewhere around, blockchain and these innovations in digital currencies. But then today, when I asked you about CBDCs, you said they were a complete joke. So
because those are two different things. You're not talking about the same thing.
So what would your model of a good digital currency to replace the Eurodollar system look like? Something that would actually work.
It would have to be, it'd have to fill the roles of the reserve currency, which means it would have to be available widely and acceptable to a lot of different places around the world. In fact, most places around the world would have to use it. And I would imagine it would have to be elastic, which is something Bitcoin maximalists hate because they like fixed currency systems, and gold people, they hate fixed currencies. They like fixed currency systems too. But I think it needs to be elastic because we don't want any deflationary development. So it has to be some form of dynamic currency system that is able to both predict as well as meet the dynamic needs of that global system. If demand goes up relative to supply, you don't want a monetary shortage, so you want supply to be able to meet demand. You want some elasticity in that system, which is, sounds really easy, but it's incredibly, maybe even possibly difficult to try to come up with in practice. But if we're talking about just an ideal, spitballing an ideal system, that's what it would really need to be. It'd be globally acceptable, available in a lot of places, and then dynamic and elastic, which is, incredibly hard to put together in practice.
Yep.
So it doesn't just come off the rails.
Yep. And to wrap up the podcast, I wanted to ask you, most people like to call you, deflation. So are you a deflationist in the sense that we're going to see negative inflation, or are you a disinflationist in the sense that we're going to see low?
I'm neither of those things. I'm somebody who looks at the evidence and says, you tell me what's going on.
But,
I don't have a predetermined position that says, oh, I'm always going to be a deflationist. I don't have a book to sell you. Yep. I don't have a position to sell you. I'm telling you that nothing has changed. That's what I'm really saying, is that, look, over the last 14 years, the markets, the monetary system itself is sending you signals that tell you the chances of an inflationary shift are close to zero. That we're seeing CPIs go up in the US, but only the US. We're seeing economic growth around the goods economy in the US going completely insane, but the rest of the economic system around the world is almost opposite. Economies are really struggling. So we look at what the markets are telling us, what the evidence is telling us, whether it's data, I just talked about the tick data recently, another dollar warning there. It's all adding up to a situation that says continuation of the underlying condition that we've been in since August of 2007. That has not changed. And whether that means deflation or disinflation, to me, it almost doesn't matter. That's kind of splitting hairs. What it is an incredibly dangerous, insufficient economic climate that will only continue to add to all of the social, political, and economic problems we've accumulated after almost a decade and a half of being stuck with the same stuff. So in the US, it's disinflationary, but as a global whole, it's probably more characterized as deflationary because you'll see outright deflation in places like Japan, emerging markets, and some other, others, where sometimes the opposite of a dollar shortage is actually rapid local inflation. It's essentially what we're talking about. I think you get bogged down in trying to again, split hairs on these definitions. What we're really talking about is inflation, deflation, disinflation. They're all symptoms of a monetary disease.
Yep.
So we have a monetary disease, a monetary imbalance that isn't of the inflationary variety. Let's call it that. And I think I would be happy with that kind of a definition.
Yep. Got it. Well, Jeff, thank you again for another wonderful interview. It's always awesome to speak to you, and we should do this again. Yep.
My pleasure, Sri. And just let me know when my trophy shows, or whenever you put that in the mail. I'm going to put it behind me right here. So.
Awesome. Thank you.